Hey Credit Warriors, Credit Shifu here, and well, you have seen the title, you know what this video is about. We are going to be talking about how I finally got approved for a mortgage. Now, this shouldn't be too hasslesome for most people, although if you are self-employed like me, it's certainly going to be a little bit more difficult, okay? And I did actually apply back in 2018, and I wasn't able to get it because of, well, reasons that I'm going to tell you about in a second. But now we are actually finally approved for a mortgage, and we have actually signed a contract to buy a property, and we should be closing on it in a few weeks. I don't want to show any pictures of it yet or anything like that until we've actually closed the deal, because these things are, even though it's probably 99.9% certain now, you know, it's not signed until it's signed. So anyway, we're going to just talk about how I got approved for a mortgage in this video. So if you are a full-time employee as of a company, you can just use 1 year's tax return to show your income for your mortgage, okay? However, if you are self-employed, you run your own company, under many circumstances, you actually have to show 2 years tax return. Now, there is a way, if your business has been around for longer than 5 years, you can actually just show 1 year's tax returns. But my business had only been around for 3 years, so they still wanted to see 2 years worth of tax returns to work out my income from. And what they do with these 2 years, they actually take the average of those 2 years tax returns, and it's only from income sources that you still have, okay? So if you used to have another job that you don't do anymore, that wouldn't count, all right? Now, that was where the problem came in for me, because on my 2017 tax return, this company that owns this YouTube channel and a couple of other YouTube channels, and we sell wallets and all that kind of stuff, my income from this company for that year was only $17,000, which I think most people would agree that's pretty low, okay? However, that year I did have another job. I had a full-time job for like the first 3 or 4 months of the year, which brought in quite a lot more money. But that money is not allowed to be used as income for the mortgage because I don't have that income anymore. So I was basically going off $17,000 for 2017 and then quite a lot higher income for 2018. And the average of the two put me at around $60,000, okay? If you're good at math, you can work out how much money I made in 2018. I'm not gonna say it, but anyway, it's no secret, but whatever. So anyway, I ended up, they could only use around an average income, around sort of $60,000-ish. And actually the US annual household average income is around that figure, 55, 60,000, I think it's like 59,000, I don't know, it depends which figure you look at. There's a few different ways of working it out, but the average is around that figure for annual average household income. So that meant that I was a bit below what the actual income I am making, okay? And in 2019, I've already made as much money as almost as much money as I earned in the whole of 2018, just in the first 5 months of the year, because I've started a company and it's been building up like this, and now I'm reaping the rewards of a few years hard work, okay? But they can't use that for the purposes of a mortgage, all right? Which is kind of crazy, but then when you look at it from the bank's point of view, it's actually quite a robust system because they want to make sure people can sustain that level of income long term. But anyway, it's annoying for people like us. Now, when you buy a house, you have to consider something called debt to income ratio, and this basically tells you how expensive of a house you can afford. Debt to income ratio is worked out by adding up all of your monthly debts. So for example, if you have a car loan, would be car payment, student loan payment, any other payments you have, including credit card minimum payments, okay? So if you say have a $2,000 balance on a credit card, the minimum payment would be like maybe like $70 or something like that. So they would add 70, okay, to that. It's worked out on the credit card minimum payments. So when you add up all of that, and then you add on your potential mortgage payment on top of that, that works out how much of a home you can afford, okay? And debt to income ratios, around 30% is considered really healthy, but obviously they will go higher than that. Most lenders will stop at around 43%. With certain types of mortgage like FHA, you can go quite a bit higher than that, up to like around 50%-ish. And so that's what I ended up doing. I ended up getting approved for an FHA mortgage, and debt to income ratio was at like 48% or something like that. But it was only going off income that they were using 2017 and 2018 tax return average of the two. So it was way, way lower than my actual income. But within those rules, that was all I could get approved for. And they knew this. They had seen, the money I'd earned in 2019 and knew that it was much higher. But that was the reason that they were allowing even that high of a debt to income ratio, up to like 50%-ish, was because they knew that it wasn't my actual income. And because seriously, you wouldn't want to be spending 50% of your paycheck on your mortgage payment. What are you going to live off of? Right? Anyway, so let's get back to the story. So I got approved for this FHA mortgage with quite a high debt to income ratio and a very low down payment. Now I wanted to put down a low down payment because the money I've got in stocks, etc., I wanted to keep it there, okay? Because interest rates are pretty good right now for mortgages. So it makes more sense for me to keep more of my money in stocks, earning like 6, 7, 8% a year, and get a low interest rate of like 4.5% on my mortgage, and it kind of cancels it out and I'm still making more money with the stocks. But okay, sellers don't really like FHA mortgages. This is something I discovered. So basically, I got my offer on a house accepted, and there was another person interested in the house, and they actually bid too, and they bid, I think, $6,000 above me. Well, first they bid the same, the asking price, and then I had bid first, right? So the seller accepted my offer, and later on, they came back and they upped it by $6,000, okay? So I had to then go and match that bid, which was really annoying, okay? Because they basically, this person, they didn't get the house in the end. They just made it more expensive for me, Anyway, so I actually matched that offer. And that person, I think they had reached their maximum budget, so they didn't go any higher. But the seller, when they found out that mine was FHA, well, this other person's was conventional. Now, for FHA loans, there are more requirements on the seller. Okay, now I'll do another video about this explaining the pros and cons of FHA mortgages, but I'll just briefly touch on it here. Basically, there are certain things, if there's paint peeling, for example, the seller has to go and paint that, all right, before they sell the house. So when it's inspected or appraised, there's a more stringent inspection, and there are more things that the seller has to do to get it ready. Otherwise, the FHA won't approve that mortgage, okay? And it also takes longer to close, and this seller was really wanting to move because he'd already found another house, and he was, getting ready to move. He wanted to move as soon as possible. Now, luckily for me, the seller actually was the boss of my realtor, okay? So he owned the company that my realtor worked for. So he was very willing to look into whatever offer this realtor was offering him over other offers. All right, so he did. That was a great advantage we had in that he gave more time to it. He's like, look, if you can get this guy, if your client, he said to my realtor, if your client can get a conventional mortgage, I'll go with him. Otherwise, I'm going to go with this other seller. And you've got until tomorrow to get it. So I was like, oh my God, right? So this whole process was like super tense. So anyway, one evening, it was like the deadline for it was the next day. I just scrambled to pull together a load of money to increase my down payment. Okay, so I went and sold a load of stocks. I even sold a few at a loss, which was not ideal, but hey, I weighed it up and I thought, do I want to actually own a house, or do I want to keep this money in stocks? I'll go with owning the house. I'll build my stock portfolio up again. I didn't sell it all completely, but I depleted it quite a lot. Anyway, so I pulled together, and I even got a little bit of a gift from my parents as well, and just money from all over, everywhere I could find. I have a little bit money, a little bit here, pulled it all together and ended up with a 20% down payment, which would, originally we were going with like a 3.5% down payment. So I ended up with 20%, which would do two things. One, it lowered my monthly payments just because I was borrowing less money. But two, once you get to 20%, you no longer need to pay for mortgage insurance every month, okay? So that knocked about $100 off the monthly payment as well. So I went from like a $2,000 and something monthly payment to more like a $1,600 monthly payment. And that then brought me down in the debt to income ratio more around 40%, which is more, it's acceptable for a conventional mortgage. And basically, I got approved, okay? And I just literally got the approval letter through on yesterday, on Friday, which is why I'm making this video, because I'm like super happy that we got approved. And yeah, that's the story, guys. So I will do another video talking about FHA mortgages, because some people on YouTube, particularly, they actually, they really say, like some real estate channels, they're really like, oh yeah, anyone can buy real estate. It's so easy. You just get an FHA mortgage, like you can do that. Also VA loans as well for veterans. Like you can do that, but just be aware, particularly with FHA, that I'm not sure about VA, but I know with FHA, from my experience, some sellers don't want it. And perhaps if there's no other demand for that property, they'll accept it. But if you're bidding against someone that has a conventional mortgage in a high demand sale, then they're going to go with a conventional, I'm sure, because it's less work for them, unless you're willing to offer more and the other person's reached their limit. But you know, so that's kind of like the pros and cons. We'll do another video on that, and once we actually have, you know, fully closed on this deal, which should be July 1st, you know, fingers crossed that it all goes smoothly. I'm pretty much 99.9% sure it will do, but you know, you never know with these things. But anyway, should all be good. I will have, you know, several more videos about buying houses. We'll have a house tour for you guys, all that kind of stuff. And so yeah, do look out for that. And I know this video, you know, it wasn't about credit cards, which is about credit in general. But hey, we'll put some of our favorite travel credit cards in the description below. So if you guys do want to support our channel and you're thinking of getting a new credit card, feel free to browse the ones in the description. It is an affiliate link, as you guys know. The advertised disclosure is in the bottom of the description section of our video. Thanks so much for watching, guys. Please leave a comment if you have had any similar experiences or just want to share and chat. Leave a comment below. I do read most of the comments, often reply to people as well. Please subscribe if you're new. We'll see you next time. Bye-bye.